Medical Properties Trust, MPW. Has the train left the station? What are some of those key risks for this real estate investment trust, for this REIT? Today we're going to dive into the bear case, looking at the risks and the challenges ahead and whether or not this is a time to sell. So stay tuned and I'll give you the update at the end of the video. So MPW has been a reasonably strong real estate investment trust performer for quite a period of time. As we can see, there's been a relatively strong increasing adjusted funds from operation over time, maintaining a good price to adjusted funds from operation, which is sort of the same as a price to earnings ratio for a REIT. But as we can see here, in the last year or so, since the end of 2021, we've seen this really steep decline in the share price of MPW. So what the blazes is going on here, and should we be considering selling, and what are some of the risks here that the market is looking at? Most likely the biggest risk and challenge for MPW is the Standard & Poor's global credit ratings here. Now this is what we can see is just before Christmas, Standard & Poor's decided to place MPW on a negative watch here in terms of their credit ratings. The big issue here is this exposure to the key tenant, Steward Healthcare, and we'll get a little bit more into this next. But as we can see here, there's been increased exposure to the one tenant, which always has a concentration risk for them. And MPW has a BB plus issuer credit rating here. But this now has a little bit of additional risk here where they're being very closely watched. MPW is being very closely watched by the credit rating agencies to understand what is going on. And are there some risks here? Well, absolutely. And that's what the market's beginning to price in and look at. Now stepping back though, just under 2 months, Moody's, a competitor for S&P credit ratings, Moody's also does credit ratings. Now they've actually revised their outlook to stable. Now, what's going on here for Moody's then? What are they saying, perhaps with the slightly outdated data here, and what are their thoughts? So a couple of key points here that Moody's raises is, number one, there's this very strong acquisition strategy that's quite aggressive, and that has some challenges with temporary increases in leverage. So in other words, MPW is borrowing money to acquire these assets. Now, the other challenge that they see here is this large tenant concentration again in Steward Healthcare, which is 30% of the third quarter adjusted revenues. So we're talking about quite a substantial risk here. If something happens to Steward, then Medical Properties Trust is going to be in deep trouble. And that's the difficulty with the concentration risk. If things are going well, it can be a very powerful propeller to really push and motivate the stock prices for the company. But when things are going challengingly for one of the key customers, as seems to be going on here, then it's really quite a serious concern for the company and for the company investors. Now, when we begin to get into it, what is going on here with Medical Properties Trust, and what exactly is this trouble and this perception of issues with Steward? So I'm turning here to the third quarter earnings call from the end of October through the ticker terminal, and we're just going to have a quick look at what exactly the company's saying about this relationship with Steward, and perhaps then we can begin to understand some of the risks and challenges. So what exactly is the issue here? Well, one of the things that many investors are getting a little bit concerned about is this close and apparently rather cozy relationship between MPW and Steward. So what exactly is going on here? Well, first of all, as they reported in the last quarter and quarter two, they supported Steward, which is a serious concern, and Prospect, which is a less serious concern, with the loan facilities. That's right, they're lending their tenants money. Now, is that a big problem? We're going to have a look at that. They also allowed one non-US tenant to defer some rent for 4 months. The tenant's back to paying 100% of rent, which is just going to show some of the difficulties and pressures on companies and tenants in this industry. So how serious is this? What sort of hole is MPW digging and what's going on? Well, first of all, it's important to acknowledge that the sector is in trouble, and it has been challenged and struggling through the COVID. And they make that point here, hey, look, there's been some operational staffing and COVID-related revenue, inflation and other pressures over the whole hospital US environment over the last 2 years. And that's been a big concern for investors in stocks like MPW, because it does affect them. It does mean that you have issues such as this tenant here, which was required to defer some of their rent for a short period of time, and it can lead to bankruptcy of tenants, which means that property is going to be vacant for quite a while, perhaps, before it is released out. Now, obviously, this is part of the challenge. If 30% of your tenants, in the case of Steward here, suddenly cannot pay their rent, MPW, and that means the investors, then are on the hook for quite a serious decrease in the adjusted funds from operation, which is always going to be an issue and a concern. Is the Steward situation really that serious? Could they actually be in trouble, and could this affect MPW? Well, the answer is probably yes. As we see here on the morning briefings here from December the 19th, so relatively recent, the Boston Globe has been reporting that it's an ugly year in healthcare, with hospitals reporting record losses in 2022. Mass General is looking at cuts and costs after an annual loss of over $2 billion. Now, this is one of the top US hospitals. It's renowned around the world. And they have struggled, and they are having difficulties. They're taking a hit from inflation, they're taking a hit from workforce issues, and it's really causing this operator to struggle. So, how is it then that MPW's tenant Steward is actually being successful and actually is coming through this intact when there's so many concerns and worries? Well, that seems strange. If a really good hospital like Mass General is struggling, why do we think that Steward is going to actually pull through this and be successful? And that is one of the big concerns here today. Is MPW digging a hole that's getting deeper and deeper? And that's one of the big challenges here for investors. They obviously have this very close relationship with Steward, as we suggested. And this is exemplified by the fact that in Q2, they made a further $150 million loan to their tenant. Now, this is the same tenant that was having difficulty extending the lending facility during this period of time. Now, obviously, it could be useful to help out a tenant during a rough patch, if it is indeed just a small, isolated, short period of time where the tenant is facing a rough patch. But, as we've seen, the entire sector is plagued by inflation and workforce issues. Is it really going to be beneficial for MPW to keep on lending money and keep on supporting this tenant? And are they going to end up regretting that? Well, the other challenges as well is we don't actually know whether or not this tenant is stable and whether or not this tenant is actually really stable and really secure. The tenant Steward has, they've neglected to provide audited details about, their financial operations. So it's difficult for investors in MPW to get a sense of whether or not this tenant is in trouble. But I think it's safe to say that, when MPW is lending money to the tenant to help them get through, and when they've got this close relationship with the tenant, and when the tenant is about 30% of the overall MPW portfolio, we're talking about some fairly substantial and fairly serious risks here for MPW and investors. So what do the analysts think? So these are the analysts who follow the company, who follow the industry and the sector really, really closely. I've turned here to the ticker terminal and I'm looking at an overview of the analyst target stock prices here. And we can see here just over the last couple of years, since 2018 through to 2020, we can sort of see analyst expectations were quite strong and improving through 2020 through to the end of 2021. Reasonably stable, and then since the start of 2022 we've seen a drop from about a low stock price target of 23 and a mean or average of $25 down to today a low of 10 and an average of about $16. So we're talking about a fairly substantial decrease and decline in the analyst expectations here. And we can see from the low here of $10 that we can see some analysts are actually really quite negative about the prospects for the company. Now, what's driving that? What is driving these expectations? I've got a chart here of the AFFO on ticker terminal, and we can see since 2010 it's sort of been increasing quite nicely up until about 2021. 2022 a small increase. Now, as we can see here in these estimates though, the FFO per share in 2023, 2024, 2025 and 2026 decreasing below this 2022 level, and that's quite concerning. Now, FFO is not the be all and end all. I'm just going to flick on the adjusted FFO here, but we can see the same type of pattern sort of peaking here in 2022, a stable level there for 2023, a minor increase in 2024 for AFFO, and then a decrease in 2025 and 2026 expected. So relatively concerning here. We can also get a sense of some of the challenges here as well for the company by looking at the net debt by EBITDA. And we can see this is quite high here at about 600%. Now, this has been relatively constant, and as we said before, hey, look, they've got an aggressive acquisition strategy, which is being financed with leverage and borrowing and debt. But we're still talking about quite a high level of debt for the company here that they're bringing on and taking on to fund this. So, okay, we've got high levels of debt, we've got a rising interest rate environment, and we've got the AFFO and the funds from operations sort of expected to decrease in coming years. Now, what does that then mean for the dividend? What does that mean for the investors? Well, it means that the dividend is going to be at risk. It means that the dividend may not be increasing at quite the same rate as we've seen in the past. It may even mean a dividend cut. Now, even under these, reasonably good circumstances that the analysts appear to be expecting, we're talking about an issue with Steward. If Steward goes under or defaults or is going to be, not paying their rent on time or in full or anything like that, we've got some fairly serious issues here for the company to face. One final concern, net debt. Hey, look, this is going up, and it is going up fast. So we're talking about a rising interest rate environment, and look at this, 2021, huge amounts of debt and relatively high debt expected in coming years as well, which is going to be increasingly difficult for the company to service, which again is going to be putting pressure on their dividend and the amount of money that they're bringing in versus paying out to their shareholders. So, where does this leave us? A final quick look at fast graphs and looking at these analyst expectations down the bottom, we can see over the last 6 months that the analyst expectations have been revised downwards. Not huge amounts, but we're talking about a REIT, we're talking about an organisation here which should have stability in the AFFO. And here in particular, looking out in 2024, we're seeing the AFFO estimates have been revised downwards quite a bit. Now, at the same time, we can also see the analyst expectations for the dividends here being held constant, so trying to maintain a little bit of security here. The bears would certainly be hoping perhaps that the dividends would be cut, and certainly if everything goes well with Steward, the dividend should remain stable, probably not growing, I suspect. But if something goes on with Steward, I think we can safely say that the AFFO is going to decrease, at least temporarily, for perhaps a year, while some of those properties are then leased out again to new tenants, and we'd be seeing a sizable impact on MPW's AFFO. And this, my friends, this is the bear case. These are the risks, these are the challenges, and this is why the market is bringing in this massive decline in the share price over the last year. And this is something that you need to think about. So, is this the full story? What are the bulls seeing? What are bullish investors seeing? And we're going to have a look at that. We're going to examine those issues. We're going to examine that case tomorrow. And then after that, we're going to wrap up and actually look at what the reasonable expectations are here for an investor and how you can begin to play this company and play this investment to try and eke out some money and some really nice dividend yield going forward. So, is this the end? No. Stay tuned, and we're going to come back to MPW, to Medical Properties Trust, and get into this later as well.